Hello, and welcome to our latest Lunch and Learn. My name is Glenn Reynolds. I'm a partner in the indirect tax practice in Dublin, and I'm delighted to be joined by my colleagues, Richard Cowley, Annette McKennan in our Dublin office, and Jenny Upton in our Belfast office. So the purpose of today's webinar is to reflect and look at Brexit the first 6 months, what we've seen, and look to the future. We're going to spend 45 minutes on it, and we'll try and keep to the time slot. It's really hard to believe that 6 months have passed, and we're now 6 months into the new trading regime with the UK. And what we've seen over the first 6 months is really an evolution. At the start in January, we had a very short lead-in period for the implementation of the TCA. We had a really steep learning curve and learning phase for everyone. There were some late nights, some early mornings, some initial panic, getting used to new processes, new documents. And the key point was making sure goods flowed and they got through. Things have more or less stabilized, and we're now into a business as usual in many circumstances. So companies have developed processes and systems, best practices, and broadly goods are flowing. The revenue statistics would show that approximately 94% of goods are passing from GB into Ireland, into ROI, without physical checks. So 84% of goods are green routed. That means they go straight through without any checks. We're seeing about 12% document checks, and that sometimes depends on how how the documents have been filed, which can lead to a check. And we're seeing 4% physical checks. So it all points that, look, things are starting to work well, but there are, of course, delays. There is more paperwork, and people have to plan for more lead-in time. And what we have seen is a change in pattern and a change in flow. We're seeing more direct shipments of goods from Ireland to the continent. We're seeing a significant amount of trade via GB into ROI via Northern Ireland, and we're seeing trade go from ROI via Northern Ireland to GB. And we are seeing some issues and complications come from that, from not only a GB VAT customs perspective, but also an Irish VAT customs perspective that Jenny will talk to. As ever, there are changes ahead. We're going to see changes to how the protocol is applied in terms of unfettered access to GB from 1 November, and Jenny will talk to that. And then we have another day, a big day in terms of changes coming into GB from the 1st of January 2022, when the easements are removed. So looking at the agenda today, what we're going to focus on in the first part, Richard is going to look at the first 6 months and what we've seen on customs matters. Etna is going to look at the VAT impact in the first 6 months, pitfalls and opportunities. And Jenny will go through the Northern Ireland perspective, again, what we've seen. Jenny will talk to the changes coming down the line. And then at the end, we'll do a Q&A session. So as always, if you have any questions, please use the Q&A button at the top of your screen, and we'll endeavour to answer as many as possible. And the slides and the recording will be sent to all the participants. So without further ado, I'm going to pass you on to Richard, and he'll get into customs in the first 6 months.
Good afternoon, everybody. 6 months in, yeah, as Glenn said, the goods are moving on the whole. There's still some hiccups, but I think the initial hurdles that have been faced have been overcome. It's still not as efficient as everybody would have hoped. There's still matters that need to be dealt with on a day-to-day basis, but if we look at where we currently stand, I mean, the significant issue is the fact that we've got declarations that need to be done. That necessarily means that there's going to be additional paperwork, there's an administrative cost. Whether you're filing in-house or you've outsourced it to a broker, there's a cost involved in order to be able to file declarations. Also, of course, there is the imposition of duty. Now, that can be ameliorated through use of the Trade and Cooperation Agreement, but on the whole, the duty is a sunk cost. So the focus has been over the past number of months is looking at ways and means of actually reducing that duty imposition, and whether you can avail of customs special procedures or reliefs to mitigate the impact of Brexit. But do bear in mind as well that in terms of moving product from Ireland into GB, and I say GB because obviously there's specific rules in the context of Northern Ireland, but recall that the UK did introduce easements, which has reduced the friction associated with moving goods through import into Great Britain. And they've also introduced easements in terms of trade with Northern Ireland. Those easements are due to be unwound or evolved. Jenny will talk about that in more detail, but it's important to be aware that changes are coming down the track. There could be additional friction that's going to be associated with that, and now is really the time to take stock of that and prepare accordingly. And what all of this means is that, there has been a change in terms of the trading pattern that we've had. New supply routes have been put on. You'll have seen all of the new shipping routes direct from Ireland to continental Europe. The traditional land bridge approach, where goods are moved from EU into Ireland over the GB territory, has lessened. There are simply things that we wouldn't have seen before occurring. We've seen one instance of an Irish business with operations in the UK, rather than shipping direct from UK into France, actually moved goods via Northern Ireland, through Ireland, and then from Ireland into France, simply to deal with some of the delays that they were incurring, clearing their goods at point of entry into France. And of course, what all of this means is that, how do you manage the incidence of these news processes? What systems do you have in place to cater for it? So if we turn now to some of the challenges that we've seen, and this is just a sample of those challenges for business. One is, it's really the operational side of this. And because of the higher incidence of declarations now being faced because of the trade with GB, the question is whether, as a business, do you have full stakeholder visibility over the customs processes? Often it's one that would be seen as, we've outsourced it to a broker. We've got some visibility on it, but the question really is, are you sure that you've got the full rigor and approach applied to it? Because at the end of the day, it is a tax risk. And we'll come on to some of those points around what it means for you in case of error and how you might best manage them. We've also seen situations where, reliefs that are available aren't being availed of. And it's important to understand what those reliefs are, particularly when you're dealing with the UK as a distribution hub. And equally, just delays arising at the ports because of, for instance, there might be a regulatory issue that hasn't been addressed, or there might be a misunderstanding in terms of how the Incoterms are going to be applied. Or, for instance, that a declaration is filed, but actually the funds are not there within the TAN account to pay the duty, assuming, of course, PIVA is being operated. And Ethan will bring you through the rigors of postbound import VAT accounting in due course. And also bear in mind how preferential origin works, and whether you've got the proof, sufficient evidence to be able to demonstrate it. So understand that, under the Trade and Cooperation Agreement, there are particular rules in place which will enable goods of GB origin to be moved into Ireland without duty, assuming you've got the appropriate evidence. And equally, EU origin goods being moved into GB can also avail of zero duty. But it's because the GB and Northern Ireland, they're no longer part of the customs territory of the EU. You need to understand, well, what does that mean in terms of your ability to apply preferential origin on your sales, for instance, or your exports to other countries that the EU has a free trade agreement with? So, for instance, in the context of trade with Canada, what will be the impact of Northern Irish product or components going into a finished product here in Ireland that you ship to Canada? What is the impact of processing that's undertaken in the UK? Will that upset your ability to apply preference under the CETA agreement? So these are all the facets that need to be considered as part of Brexit. It's not solely limited just to the Trade and Cooperation Agreement. And then I think as well is looking at the challenge around that declaration accuracy, the challenge of making sure that you've got the supporting evidence in place, and the data gaps that can arise. It's critical that declarations are filed appropriately and are correct. At the end of the day, these are their tax return, and should be treated in the same manner and with the same risks associated with that as would be a VAT return or a corporation tax return that you would file. And think about that where you have outsourced that, or indeed you're dealing with it in-house, treat it as something that will require checking and approval and build a framework around that. So some of the pitfalls that we've seen over the past while include, looking at DDP sales into Ireland. There's a number of issues that stem from that. Sometimes there's a misunderstanding of what Incoterms mean and how they're going to be operated. You take an example of Irish customer agrees to purchase goods on a delivered duty paid basis from a UK supplier. Well, UK supplier is responsible for dealing with the import clearance in Ireland under DDP. Yet what we see is that there's a number of our clients who faced a situation where they discover that actually they're being required to file the import declaration, or rather the import declaration is being filed in their name. And that carries with it risk because it was the responsibility of the vendor, and now it is going to be a responsibility of the purchaser here in Ireland. And there needs to be an understanding as to how to manage that appropriately, because sometimes traders just need to get the stock on the shelf. And so there will be workarounds that are done, short-term fixes to cater for that. Also bear in mind that sometimes we see in terms of the valuation for declarations on a DDP basis, the duty element is actually calculated on the full invoice price, whereas there are ways and means of dealing with that so you can actually apply a reduced amount of duty overall. And think as well about moving goods for repairs or processing between Ireland and Great Britain. You know, often there's a duty associated with that, but moreover, there's a VAT element associated with that as well. That's important to be aware of in terms of the ability to deal with VAT at import. But the critical piece, I think I keep coming back to this, is in terms of declarations and ensuring that those declarations are accurate, that the correct commodity code is placed on them, that you've got the correct valuation on them as well. It's really important that this is dealt with now because these errors tend to be recurring. Best to deal with it today rather than building up a problem for a later point in time. And remember as well that there will necessarily be customs audit and post-clearance check audits that will take place. So try to manage this now and deal with any issues today rather than letting them build up and identifying larger issues at a later stage. But despite all the pitfalls, there are opportunities. In terms of focus would be on looking at ways of reducing the amount of duty that you need to pay. And what are the ways and means of being able to do that? Well, clearly you would look at origin and being able to identify whether you can claim preferential origin. Remember, it's not just a case of simply because something comes from GB, that does not mean it's of GB origin. But we've seen that actually on declarations, that simply because it came from GB origin is being applied. You need to make sure it's truly of GB origin. You need to have the proofs to do it. It'll either be a certificate from the supplier, or alternatively, it might be your own importer's knowledge. But if it is based on importer's knowledge, you really need to be comfortable that you can support that if asked. And also look at returned goods relief. So this is the classic Percy Pig issue of EU origin goods or EU goods going into GB, free circulation. Some of them, 90% will be used for the UK market, but an amount will come back into EU, come into Ireland for sale. And you can look at returned goods relief as a way to actually avoid the duty impact, or indeed submit claims for refunds. Also look at classification. Be sure that your code is correct for the type of product that you're dealing with. Closely look and see whether there are alternatives that are match better and whether they deliver a lower duty cost. You may find situations where they're higher, but often you'd look to see that you've got the correct one. And if you need to get comfort, you can get rulings from revenue or a BTI from revenue to give you certainty around the fact that you're using the correct code. And then also look at valuation. Valuation is often, there's a number of different valuation methodologies, but in most cases, it'll be a transaction-based methodology. So effectively, the invoice value. But you need to take into account the Incoterms that are being used, whether freight costs and insurance costs are included. And this is something that's worth looking at, because often you'll be in a position to actually reduce the amount of duty that's going to be paid. I think as well, in the lead up to Brexit, a number of companies took customs compliance in-house. A lot of other companies decided to leave it to the brokers to deal with it, and that'll continue on because that fits their business well and works well for them. But I think more so, businesses will continue to think about whether to bring it in-house or whether to continue on with their outsourcing model. There can be efficiencies by bringing it in-house. But bear in mind, there is necessarily a cost associated with that. And that's one involving ensuring you've got the correct systems in place, the correct staff, capable, trained, experienced enough to be able to file those returns. But it can longer term deliver savings, but it's not for everybody. Think as well about the supply chain that you have in place. Now is a good time to think again as to whether there's efficiencies that can be made by either routing it from different suppliers or going via different routes. Clearly it will not be applied to all cases. You know, a lot of companies have traditional supply routes with their main suppliers, and it's difficult to move that around. But think as well about custom special procedures like inward processing or AEO. These are ways and means of either clearing goods faster or alternatively suspending duty and reducing your duty cost. So a lot of these things were thought about in the lead up to Brexit. Many implemented them, but not everybody did because people were adopting a wait and see approach. But it's something now that's back onto the agenda to refresh that supply chain and assess whether there's things that can be done to improve the efficiencies. So in terms then of what businesses should be focused on over the next 6 months, and I've touched on a number of things, but for me, I think it's a case of that compliance aspect. I think the key piece would be, are you ready for a revenue audit? So tomorrow, if there was a customs audit placed on you, how ready are you for that? Do you have, or are you comfortable that those declarations are accurate? Do you have the necessary evidence in place to support it? How quickly can you get that evidence? And whether you're doing it in-house or you're doing it with a broker, I think it's important that you've identified and documented the roles and responsibilities and that they're clearly defined. You know, how are you going to deal with errors and exceptions? How are they reported and managed? Do you actually have a program in place whereby you carry out post-audit checks or indeed pre-submission checks? So these are ways and means of trying to manage down the risk associated with the declarations, but also identify whether you're overpaying duty as well as underpaying duty. And think as well about that points around origin and classification. They're key elements within the risk profile. And then in terms of your systems and procedures, you know, for many businesses, the early days of Brexit was, look, we just need to do something to get the goods through. And there's a short-term fix that's been applied, and that was absolutely necessary. So question now is whether, is there a longer term fix that is good and would work better and provide more efficiency? I think overall, the businesses, I'd suggest step back, take a bit of time, just reassess the profile of your trade, reassess how good those declarations are being filed, how accurate are they? Are you ready for a revenue audit? Are you comfortable about whether you're under or overpaying duty, and that you're prepared to look at this again to ensure that you've got the best processes in place to manage this long term. So with that, I'll hand over to Ethna, who's going to bring you through some of the VAT impacts.
Thanks, Richard. Looking at this slide, I'm going to give an overview of the Irish VAT system post-Brexit on one slide, a little bit ambitious. But for supplies and movements of goods, we do have a distinction between Northern Ireland and Great Britain. So the movements or supplies of goods between Ireland and Northern Ireland, it is effectively business as usual for VAT purposes because the pre-existing, pre-Brexit intra-EU VAT rules are effectively continuing to apply to those. But a big distinction, as we know, is for supplies, movements of goods between Ireland and Great Britain. And in that case, we're obviously now dealing with completely different VAT rules for imports and for exports. In other words, the system that would apply for non-EU transactions. And import VAT for incoming goods coming into Ireland can be managed by using the postponed import VAT accounting regime, or PIVA for short. So I'll be touching on that later, and also Jenny will look at the UK equivalent of PIVA. Regarding services, in one way it's more straightforward because there's no effective distinction between Great Britain and Northern Ireland from an Irish VAT perspective. Instead, the UK is now recategorised as non-EU. What does that mean though? Because in practice, the VAT treatment of most business-to-business services, B2B services, remain the same. What I mean by that is that they continue to be taxed where the customer is located at whatever the local VAT rate is, and that VAT is operated by way of the reverse charge, so the VAT obligation falls on the customer. Same as before, effectively. But there has been a change in the treatment from an Irish VAT side of some B2C services, so business to consumer supplies of services from Ireland, such as consultancy, legal, IP, and the like. Now, if we move on to the next slide, let's look at PIVA and some practical issues that we're seeing businesses face about that. So in terms of eligibility, what you need to be is Irish VAT registered, and also importantly, registered for VAT and registered for customs and excise in advance of looking to apply PIVA. So it's not an establishment test. It's not just available for imports from Great Britain. Instead, this is a mechanism that's optional and available for imports from outside the EU. So not just GB focused. The declarations are key. As we've heard from Richard, accuracy of declarations is so critical, and making sure that the PIVA election is recorded appropriately on the declaration is an absolute must. Where PIVA is used, there's a cash flow benefit for many businesses. In other words, businesses that would ordinarily operate with full VAT recovery in Ireland, because in that case, what we see is that reverse charge VAT is being applied. The import VAT is recorded in the VAT return effectively as an in and an out, so cash flow neutral for those importers. But obviously, if an importer had restricted VAT recovery, they could still elect to use PIVA, but instead of having a cash flow neutral position, there will be some net VAT bill due and required to be remitted to revenue on the import. Statistically, there's always information in VAT that we need to give to the tax authorities. So you will have seen that the VAT return has been updated to include an extra field to give box PA1 information regarding the imports made on the PIVA. And the risk here is effectively that, well, if you apply to use PIVA, what happens in the VAT return? What are you expected to be doing? And the reality is there is the full expectation that reverse charge VAT is recorded in the return and that these are being declared correctly. If not, the risk is that you're deemed not to have paid the VAT if you haven't recorded it in the return. So it's a very important point and not just an academic issue. To assist businesses, though, in using PIVA, and I suppose facing the fact that there's been some reluctance by businesses up until now to take on PIVA because of the data problems, because of putting together the returns, because of all these real issues. What we've seen, and it's been very helpful, is that Revenue have been updating ROS, the Revenue Online system, and that resource for businesses, so that is now capturing, if you're making your declarations by AIS, you can go in and get weekly, monthly information on imports, and that can be helpful when putting together the VAT return to have that data that you can then compile. Getting the recording right, though, is always going to be the obligation of the importer. So data and system setup is key, very important here, because you'll be having perhaps recurring transactions and making sure you're getting it done right. What we would see as a concern in businesses, and it's really a right question to be asking, for businesses to say to themselves, am I actually aware and do I have full visibility on what's going on? And a lot of this touches on what Richard's already covered. So it's about utilising the information available from Revenue and also making sure that you can stand over those figures. So looking into the future, really it's about having a process that's robust, having reconciliations, making sense of the figures that are going into your returns, and effectively being audit ready. Now, if we can move on, in summary, some key areas of challenge on Irish VAT for businesses can be summarised here. And then the next slide, I'll look at some practical pitfalls surrounding them. So firstly, that issue about wanting to make sure that if you are electing to manage import VAT by PIVA, that you're operating PIVA correctly, and that do you actually have your associated systems set up correctly to support you in that. There's a second major issue, because whenever there's VAT, there's the issue of VAT recovery. So that's no different. When it comes to import VAT, the question of VAT recovery is key. And we do have a conundrum, as usual with VAT, that we need to be able to sufficiently link VAT that's being incurred to a vatable activity. And I'm going to touch on that again as a pitfall in my next slide. And then also we're seeing issues around delivered duty paid sales, DDP sales, and some of the obligations that's throwing up for the relevant supplier. So let's look at some of these pitfalls in our next slide if we move to that. What are we seeing in the first 6 months? What kind of thing is causing a headache on the VAT side for businesses? So firstly, systems. You'll see I have a point here about systems configuration. So what you could see there is businesses charging VAT when they actually didn't need to, because the system wasn't set up to deal with the new rules. And then we have a recurring problem that's getting bigger and bigger. because of the transactional nature of VAT. I mentioned already that the VAT has to be dealt with and that there's an accountable person, but let's look at DDP sales from a UK seller's perspective. So if a UK seller is owing VAT in Ireland, there are some formalities that might seem straightforward, but that can really cause consternation. For example, dealing with foreign exchange, making sure that your invoices are quoting the VAT figure in euro. These are some very real issues that businesses are having to grapple with. Now, there's also the issue that VAT is being paid but not recovered because it's getting lost in the system. The import VAT is being paid at one point but not tracking through and then being captured as a reclaim in the VAT return. So that's something to watch out for in case there's some VAT there available that's on the table and you could be recovering. But conversely, VAT recovery is only aimed at VAT. So the customs element should not be recovered in the VAT return because effectively it isn't a VAT tax. Going back to the VAT on DDP sales, that's triggering VAT registration obligations, filing obligations and the like for the relevant seller. Now, if we go back to the import VAT point, and I've been mentioning PIVA previously, PIVA is just a mechanism for dealing with import VAT. But I also mentioned that the underlying question is there VAT recovery on the import VAT? So what we're seeing in practice in the first 6 months are some very good questions being asked by businesses. If there's VAT being incurred, who should it be recovered by? Is the VAT being recovered in the correct legal entity? Is it going into the wrong legal entity? So for example, you might see in group company situations, is the right entity actually recovering the VAT? Is the right entity recovering the VAT in asset finance scenarios? Is the correct amount of VAT being applied? And is the appropriate paperwork there to support the VAT reclaim? Is there actually a direct link between the import VAT being incurred and a sufficient link to say, yes, we have VAT recovery and we may choose then to deal with import VAT through PIVA or the like. Now, if PIVA is being applied, I already mentioned as a pitfall if the VAT isn't being recorded, and there could be, as I mentioned already, lost VAT to the Exchequer as well if there's restricted recovery. But even if there isn't restricted recovery, there's a full expectation that it must be recorded. There's also the question of, well, if you haven't been applying PIVA up until now, and I mentioned already some reluctance that we've seen from businesses, should you start? So we would expect to see a growing comfort from businesses in using PIVA because of the additional information available from revenue, which is always positive. But I think, again, to repeat myself, it's so important to make sure you've got your processes right to support what you're putting into your VAT return. And then there are my last two pitfalls that are cropping up at the moment, or in the last 6 months, are to do with some supply chains that have been sitting there working very well for a number of years, but they were reliant in a VAT perspective on certain EU VAT simplifications. So, for example, triangulation relief, call-off stock relief, or margin schemes. There are certain EU VAT simplifications that presuppose that there are EU parties in the supply chain, and it can become more complex, or in fact, the relief may not be available once you insert a UK party into the supply chain or a UK jurisdiction into the supply chain. So that would need to be looked at by businesses where those reliefs are being relied on. And lastly, PIVA presupposes reverse charging for VAT on the goods coming in and being imported. But also I mentioned already that for services and B2B services, the reverse charge continues. So another pitfall that we've been seeing over the last 6 months is a misconception in business that there is no obligation to reverse charge or account for VAT on services being received here from UK suppliers, but that's not the case. We still have the reverse charge obligation, and depending on your VAT recovery position, there could be a net liability arising, for example, where you have restricted recovery on your purchases. Now, if we move to the next slide though, we also have opportunities that we're seeing some businesses being able to access in this first 6 month period. So previously, businesses had said, listen, PIVA is not making this easier for me. We need further enhancement. We need data capture in ROS. So the opportunity now is that is being put in ROS, that revenue are making those changes. So I think it is something for businesses to try to revisit and to see, is this the correct fit for it as an opportunity to manage import VAT effectively? I mentioned already that some businesses are not recovering the VAT that they're actually entitled to. So once you're happy that it's been correctly incurred, is there some VAT there on the table that you can recover and that you haven't yet included in your return? I mentioned already that the UK is recategorised as a non-EU jurisdiction in respect of services transactions for VAT purposes. And as a result, there should be an upside for businesses in the financial services sector, and where they're selling into the UK, including Northern Ireland. Previously, pre-Brexit, we would have had a problem for VAT recovery that financial services, VAT exempt services were being provided to an EU counterparty, and therefore there was no recovery. Whereas as a consequential upside or optimization from the recategorization of the UK as a non-EU country, you'd expect to see increased VAT recovery on costs directly relating to those transactions, but also importantly, an uplift on the general overhead VAT recovery rate. And then again, an additional optimization of, well, I suppose, why wait until the annual review is being carried out? Why not look at that now and see whether you can optimize and increase VAT recovery now? There are other VAT consequential changes that aren't bad news as a result of Brexit. And, you know, we have situations I mentioned about B2C services being provided from Ireland. We're seeing instances, for example, where services can be provided to UK holding companies without an Irish VAT charge. Now, if we move on to the next slide, what we have at this stage is we've looked at the Irish VAT position, but I'd like to hand over to my colleague Jenny to bring us through the Northern Irish perspective.
Thanks very much, Ethna. As many of you may be aware, the VAT and customs landscape in Northern Ireland has become significantly more complicated as a result of Brexit and the Northern Ireland Protocol. This has all contributed to a large number of changes with how VAT and customs are dealt with, particularly with respect to Northern Ireland's trade with the rest of the UK or Great Britain. Therefore, firstly, just to take a look at the various Northern Irish supply chains in what might be a bit of a recap, but it's important to understand how these are treated and the differences that apply. Firstly, looking at trade between NI and the EU, including Ireland, as Ethna has gone through, the previous EU VAT rules have continued to apply in relation to the movement of goods, just with the addition of needing an XI prefix on the VAT number for the NI suppliers. Then, looking at goods moving from NI to GB, there is unfettered access for NI businesses where NI qualifying goods can move freely from NI to GB, as was the case pre-Brexit, and these supplies are regarded as normal UK domestic supplies for VAT purposes, and generally there are no declarations, tariffs, new regulatory checks or customs checks needed for Northern Ireland businesses. Movement of goods between GB and NI is an issue that people have probably heard more about in the news recently, as it's quite topical. For goods sold between Great Britain and Northern Ireland, VAT will continue to be accounted for as it was prior to Brexit. This means that the GB seller of the goods continues to charge its NI customers VAT, the same as it was before, even though it's technically an export from GB and an import into NI now. Now, one area that we have seen some confusion from clients is in relation to the movements from GB to NI, where a GB business moves their own goods to Northern Ireland and it remains the owner of the goods. This is regarded as a movement of own goods for VAT purposes, and VAT needs to be accounted for as both output and input tax on the one return of the GB business. So it's an administrative issue which is VAT neutral if the business is fully taxable for VAT purposes. Also, just to note in relation to this doesn't apply when a Northern Irish business moves its own goods from NI to GB. There's no in and out entry required in the UK VAT return in this instance, so there's a bit of a distinction there. Then where goods move from GB to ROI via NI, the VAT treatment can be quite complicated here, and it depends on the specific circumstances arranged between the parties. Where the sale takes place in GB, this is a zero-rated export to the EU, but also the Irish business is charged UK import VAT, which they can recover under the EU VAT refund scheme, or in some cases transit can apply and you can avoid this. Where the sale takes place in Northern Ireland, then there's a movement of own goods from GB to NI, and then an intra-community supply from NI to Ireland, so there are two distinct movements there. And we understand that this is a complicated area and one which we do not believe is being dealt with completely correctly in many instances, so it's probably just one to look out for. Something that was only recently introduced at the start of July is in relation to B2C supplies involving Northern Ireland. The EU's e-commerce package introduced changes in respect to the movement of goods from Northern Ireland to the EU, where you can choose to use the one-stop shop, the OSS, union scheme to manage the VAT on your distant sales of goods from Northern Ireland to the EU, all in the one place. Changes are also introduced with respect to the import of low-value goods, that is, with the value not exceeding £135 or €150, into the EU or Northern Ireland. Also, where supplies are made through online marketplaces, they will be deemed to be making the supply themselves and will be responsible for accounting for the VAT. This is similar to the rules that were introduced at the start of the year in Great Britain for these types of supplies. As I mentioned that the supply of goods from GB to NI is an export from GB and an import into NI, this therefore requires a number of customs declarations to be completed to deal with these movements, and you may also be liable to pay EU customs duty. In recognition of the changes that apply to VAT and customs in Northern Ireland, the UK government introduced the Trader Support Service, or TSS. This is a free-to-use service that helps businesses and traders of all sizes to move goods from Great Britain and Northern Ireland. TSS enables entities to complete declarations without the need for specialist advice or specialist software. It also provides free online courses and training materials. We understand that TSS is generally working well at assisting entities with the completion of the customs declarations. However, it won't be able to deal with special procedures like inward processing relief and returned goods relief until the end of August. And we also understand that many clients have been experiencing issues with getting supplementary declarations submitted. There's currently an extension of 175 days for when these declarations need to be submitted following movement. And this is going to continue to apply until the end of this year. However, this may not be working under TSS as smoothly yet as intended, but hopefully the functionality will continue to improve. Something which lots of clients have been asking us is in relation to XI EORI numbers, which are different to XI VAT numbers, but both of which are quite easy to apply for. If you move goods between Great Britain and Northern Ireland, businesses need an EORI number that starts with XI. You also need this number when moving goods between Northern Ireland and the EU, and it must be used when making a declaration in Northern Ireland too. To get an EORI number that starts with an XI, you must already have an EORI number that starts with GB. But as I mentioned, the application is a relatively straightforward process. Now, one issue that's coming up a lot, in particular recently, relates to whether goods moving from GB to NI are at risk of moving to the EU, such as Ireland, as this is important for the purpose of whether you have to pay a duty. At-risk goods will be charged the applicable EU duty, and not at-risk goods will be charged no duty if entering Northern Ireland from free circulation in Great Britain. Goods can be not at risk due to the applicable duties. That is where the applicable EU duty is 0 or the applicable UK duty is equal or higher than the applicable EU duty. And another option where goods can be deemed to be not at risk is where you are authorised under the UK Trader Scheme, and this applies where the goods are for sale to or for final use by end consumers located in Northern Ireland. For a short time, up until the 1st of November, you can be authorised under the UK Trader Scheme to declare goods not at risk without having your own fixed establishment or address in Northern Ireland. However, from the 1st of November, to apply for authorisation under the UK Trader Scheme, you must either be established in Northern Ireland or have a fixed place of business in Northern Ireland. And if you don't meet the full establishment criteria for the UK Trader Scheme by the 1st of November, your authorisation may be revoked. Another way of not being required to pay duty on bringing goods into Northern Ireland from Great Britain, which is not commonly known, is where you may be eligible to claim under an EU waiver on customs duty, which means that you would not have to pay the duty owed if you have not exceeded certain EU allowances at the point your import declaration is submitted. It is currently not possible to claim a waiver on duty for goods that might be charged at risk tariffs when entering Northern Ireland from countries outside of the UK and the EU. Now, most businesses can claim up to a maximum of €200,000 of aid, which does not just relate to customs duty, over a period of 3 years. And this 3 years is assessed on a rolling basis and includes de minimis aid, which is not related to customs duty, such as employment allowance. It should be noted that you cannot currently claim a waiver from customs duty if your business is involved in certain sectors, such as the agricultural primary production sector or the fishery sector. Then looking at issues we've been seeing, particularly with supplies between Ireland and Great Britain. One such issue that clients have been seeking advice on is where sales are being made on a DDP, that's delivered duty paid basis, into GB. Ethna has referred to this from an Irish perspective. Under DDP terms, the Irish supplier is responsible for importing the goods into GB, clearing them through UK customs, and then supplying them to the customer in GB. So this involves the Irish company exporting the goods from Ireland, importing them into the UK, and then making a domestic sale in the UK. This is happening quite frequently, and it's important that the Irish company has a UK VAT registration in place to deal with this. This gave rise to a large number of companies being required to register for UK VAT and caused massive delay with UK VAT registration applications in late 2020 and early 2021. But HMRC appear to be much quicker now with the registration applications, which is a bit of good news, as was causing a lot of administrative issues when VAT numbers were not being issued. Also, as referred to by Ethna, these new UK VAT registrations can avail of postponed import VAT accounting, or PIVA as it has become known, on imports of goods into GB. Similar to the provisions that apply in Ireland, PIVA allows owners of goods coming into the UK the ability to postpone import VAT from the time the import takes place to the time you submit your VAT return for that period. Where businesses can recover VAT, PIVA has removed the need to pay the VAT up front and then having to wait for a C79 certificate to arrive in the post before the VAT could be recovered. Therefore, PIVA is great from a cash flow perspective, as you can pay and recover the VAT at the same time. However, we understand that there have been some delays with issuing the PIVA statements by HMRC, and therefore businesses are having to rely on other records to recover VAT and the VAT returns until this gets resolved by HMRC. And another common issue we're seeing with clients is where they are Irish established, they cannot be the declarant on the UK import declaration. That's the form C88 or SAD, the single administrative document. Therefore, they need to appoint an indirect representative to be the declarant, which is a business established in the UK. Now, often a customs agent or a freight forwarder can fulfill this role. However, in practice, some customs agents are reluctant to be indirect representatives as they will have joint and several liability for the customs debts, and they're unlikely to take this on without significant cost to the importer. Sometimes details of a UK established group company can be used as declarant, but it has been causing some issues for companies. So again, it's just something to be aware of. So then moving on to the next slide, we can see some of the key milestones for NI-GB trade. So over the coming months, there are scheduled to be changes and removals of a number of easements that are currently in place. In the second half of this year, phase 2 of the NI qualifying goods definition is due to be introduced, which may have implications for the way and the types of goods that have unfettered access to the GB market from NI, as an NI establishment test is expected to be introduced here. From the 1st of October, there will be an end to the extended grace period for supermarket agri-food with export health certificates required for products of animal origin. And also from the 1st of October, the temporary arrangements relating to B2B movements of goods and parcels not being required to submit declarations where the value of the goods is less than £135 is being removed. From the 1st of November, as I referred to there earlier, there will be an end to the temporary UK Trader Scheme authorisations where there is due to be a requirement to have a fixed address in NI going forward. So then moving on again then to the next slide, we can see some of the key milestones for Irish GB exports. From the 1st of January 2022, one of these main changes that will affect Irish businesses is the end of deferred declarations, where the need to submit supplementary declarations and pay UK customs duties will no longer be deferred. And also entry, safety and security ESS declarations will be required from this date too. So therefore, although goods may be moving today, we're aware of many businesses deferring import declarations and duty, with goods pretty much moving now as before. But from the 1st of January, it is going to become much more difficult as there will be a requirement for all goods to have full customs declarations at the time of import. Businesses are going to need to get access to CFSP, that's Customs Freight Simplified Procedures, which is an electronic declaration that significantly speeds up the import process, as full customs declarations have only been required at the time of import for controlled goods since the start of this year. So this will be a significant change. Therefore, businesses should ensure that their supply chains are robust so that they don't encounter problems at the border. Other changes are also scheduled from the 1st of January, such as pre-notification, phytosanitary certificates and documentary checks for low-risk plants and plant products, and physical SPS checks on high-risk plants, agri-food and feed required at border control posts. Each of these changes will introduce an additional administrative and practical change, so it's just to be aware of them as we approach the various deadline dates. And also just in addition to this, and a little bit separate from Brexit, just want to very briefly mention making tax digital, as this is important from a practical perspective, as many businesses are going to have registered for UK VAT for the first time recently, and the provisions of MTD are gradually extending. UK VAT returns should be submitted using MTD specialist software with digital records in place for all VAT return workings, and there must be digital links in place between all the digital records. MTD will apply to all UK VAT registered entities with effect from the 1st of April 2022, as there are some exceptions currently in place. So just to be mindful of this, particularly where you are newly UK VAT registered, as it may not be on your radar at the moment. So just the last word on Brexit for Northern Ireland. Although there has been speculation about what the next steps will be, I guess the key message for businesses for now is that existing protocol requirements, although they're somewhat complicated, will continue in terms of customs and regulatory issues. So businesses should continue to operate under the current provisions, remembering the different rules that apply to each of the supply chains between the different jurisdictions, and that this should all continue until there are any definite developments between the UK and the EU. So I'll just hand back to Glenn now.
Thanks, Jenny. I'll just do maybe a brief recap on the takeaways. Very enlightening, Richard and Edna, and just conscious of the time. We've got a lot of questions in, some are quite repetitive, so I'll do the brief takeaway and then we'll answer a couple of questions and then we'll wrap it up as we said, we finish at 12:45. We maybe give it 3 to 4 minutes to go through the questions, and then we close. So the key takeaways, I think key takeaways for me from today's piece was, because Richard and Etna said, look, for many of the imports and exports, they're working well. Businesses have established processes, systems, and controls. Some have changed supply chains, but broadly, it's working well. Goods are getting through. I think the key message is really that for relevant stakeholders in the business, if you're in tax or if you're in finance, do you have visibility on how the declarations are filed? If you're claiming origin, do you have the relevant paperwork? And as Richard said, would you be revenue ready if you had an audit in the morning? And that's a key point. Something we're seeing some businesses do very well is the standard operating procedure and broker instructions. So it would be common to engage with your broker and say, right, this is how we want declarations completed. We want you to apply PVAT. We want you to use this classification code. And as Richard said, you either might use pre-entry, and quite often you will do post-entry checks on a regular basis, just to make sure that how you expect the declarations to be completed are actually completed. Another takeaway is, are you missing opportunities? Are you buying, for example, from a UK distributor, paying duty when perhaps you could apply return goods relief? Do you have the wrong commodity code? Or are you missing import VAT? Now, import VAT won't be charged, so it won't go through your typical AP system. But do you have a function and a process in your business to capture VAT that you may have been paid is billed to you by a broker, and you can check it out on your ROS account. Watch out for VAT. Do the simple things. Avoid the pitfalls. I know PIVA came up a lot, but there is a nasty surprise in Irish law that if you don't put it in your VAT return, you're deemed not to have paid it. So it will be a deemed VAT underpayment if you don't do it correctly. So do the simple things right. I think that's a good start from a tax point. Really comprehensive from Jenny, and my takeaways at Northern Ireland is complex. We know the supply chains are changing. We know not everything is being done correctly in terms of VAT and customs recording. So it's important, if you are using that supply chain route, to make sure that you're complying with the relevant rules. And then lastly, again, for Irish businesses exporting to GB, familiarise yourself with the changes that are coming from 1 January 2022. The easements are being removed, and declarations will be needed on a live basis. And for example, can you still avail of a deferred basis by using CFSP or having access to CFSP be an agent? So I'd make sure you're ready for that. Maybe to bring the rest of the panel in, we've got a lot of questions in the area of PVAT. And Edna, maybe I'll put this to you, and I think it's a good question. Someone's asked us, where do I get the information from to now on ROS? And do I use PIVA to record import duty, or is it just VAT?
Great. Well, the information is on ROS in the C&E statement, where you are, filing on AIS. You can get monthly or weekly breakdowns, so it's available and downloadable from there. In the PIVA recording in the VAT return, it is only VAT. So the funny point there obviously is that the VAT values have been based on the custom valuation and a few adjustments, but they are VAT figures that are put in, and then the VAT value is put into the VAT return, but the custom duty itself isn't reclaimed, isn't paid by way of the VAT return.
And someone's asked, is PIVA a transitional measure, or is it here to stay?
Oh, thank God, let it please just stay, because if it goes, people will have changed their system. No, we have no reason to believe it's going to be taken away. Let's hope that there are further enhancements, though.
Excellent. And there was a question, are PIVA downloads available from revenue similar to HMRC? And what you've said is they're available on ROS now on your weekly and monthly statement. You can identify the VAT postponed, and you can use that to complete your VAT return. Richard, we had a couple of questions in on repairs, and it was saying, how do I deal with goods sent to Ireland for repair from GB? Are there special procedures?
It used to be so easy. Pre-Brexit, you'd move from GB into Ireland. As long as you got repaired, moved back into GB, there's basically no VAT or customs duty implications from that, except on the VAT on the service fee and reverse charge basis in the UK. Now, of course, right, so there's a border. So starting position, you move that item into Ireland, there's a declaration, potential payment of duty, VAT. And I think the issue there is there are provisions in the TCA, right, that deal with repairs, effectively enabling zero or no duties to apply. But the problem, I think, Glenn, is more of a VAT problem. I know, look, in the UK, HMRC came out, very strongly in terms of if VAT arises at import, the only person who can claim back the import VAT is the owner of the goods, or the person who has got the power of sale or of those goods. Ireland doesn't quite apply that same level of structure around it or rigor, but it's there, right? It's hanging in the background, and there is case law around this. So if you bring that item in for repair into Ireland, I think there's VAT arising on it. I think there's a real question mark around the VAT recovery position of that import VAT if the VAT's going to be tried to be deducted by the repairer. Okay, I think that the strict position would be it's really only the owner of those goods when they're coming to Ireland for repair. The VAT arises at the time of import, that it's that person, the owner, who can reclaim the VAT, and that's relevant because a number of companies will take goods back from customers and shift them over to Ireland to be repaired, so they won't necessarily own the ownership is with a third party. In saying all of that, right, there are ways of dealing with it. Okay, you would look at using inward processing in Ireland. By availing of that, that would deal with the VAT, would deal with any duty element as well associated with it. So I think that's probably, if you're dealing with repairs coming into Ireland, that's probably the path that you'd look at.
Great, thanks, Richard. This is one we get quite a lot. I work for a service company. We buy items from the UK through Amazon. We paid the customs. Do we need to do any additional reporting? We get that question in different guises from clients.
Yeah, no, I don't think that there is, Glenn. I mean, it kind of depends on what the T's and C's are with the Amazon site. If I understand it, I think they take a deposit of the duties and VAT arising at the time of the order, and they then manage all of it from nose to tail, whether it's being courier or on post delivered. So on that basis, I don't think there's any additional requirement for the purchase here in Ireland, as long as Amazon cater for the payment of that duty and that VAT. There may be changes with marketplace sales. But you really need to get into seeing exactly what it is that Amazon are saying in terms of how to deal with the import aspect.
And we've got a lot of questions about declaration checks. It's what level of check could I do, and where do I get the information? I think that's a good question. Where do I get the information? People are asking to do these checks.
Yeah, I mean, there's different ways of doing your checks. You can obviously do a paper exercise and do it that way, right? Which is good. And look at the documentary evidence to support the entries and make sure that they're right. You can also do it by, you can do a kind of data interrogation type exercise. So you'd pull the data from the weekly and monthly reports on RODs. You can get data from your broker, for instance. Now, brokers will have slightly different data between them, but that's often a good way of being able to get large format transaction and declaration data entries. And then you'll be able to carry out a data interrogation exercise, which will enable you to focus on where the true risk areas are. And those are the ones that you would look at more closely.
Richard. Jenny, a couple of ones in on UK VAT. I think anyone. I'm an Irish business. I've incurred UK import VAT. I'm not VAT registered. Can I deduct the VAT?
In this case, we are not UK VAT registered, and you're incurring, say, VAT because you're bringing goods into Northern Ireland, or goods are moving via Northern Ireland. In that instance, the only way to get it back is through the EU VAT refund scheme. So unless you're UK VAT registered, that's the way you have to get it back now.
But Irish businesses can get it back. It's
you can get it back. Yeah, you're entitled to get it back, but it's maybe just not. Obviously, it's a bit more complicated now because of.
Once you're a fully vatable business and it relates to that activity, the UK will give reciprocity.
It will, absolutely.
Separate application. Perfect. And the context of this one isn't clear, Jenny, so I'm not sure if it says if you use a GB ERI instead of a Northern Ireland ERI, is there any impact? The context isn't clear, so it might be hard to answer that question.
Yeah, the XI ERI should be used for all movements of goods through Northern Ireland. and you're meant to have your XI VAT number in order to be able to avail of the conditions that apply under the NI protocol. So might depend on the context of the question, but I think it's just important that if you have a GB URI, but you're actually moving goods through Northern Ireland, or you're making a declaration in Northern Ireland, it's important that you do actually get your XI URI, and it's very easy to apply for it, but it is just important that you get it to make sure that the terms of the NI protocol can apply to you.
Perfect. I'll give the last question to you, Jenny, and then we wrap it up. It's could you provide further detail on the change from 1 November 21 regarding Northern Ireland unfettered access to GB? I think this is to do with having an establishment in Northern Ireland.
Yeah, that's the main change that's coming in. At the moment, there's been a pretty much kind of a light touch approach in relation to this. And it's kind of where NI qualifying goods, that's goods where they're in free circulation, Northern Ireland can have unfettered access into the GB market. And from the 1st of November, the UK government are getting a bit stricter on this. And in order to have the unfettered access, you're going to have to show that you've got an establishment in NI in order to avail of that. So that's kind of the main change that we expect to see from the 1st of November there.
Okay, perfect. Thanks, Jenny and Richard and Etna. It was very, really helpful. And I hope everyone who's dialed in, they will take away some nuggets. It helps them in the day-to-day application. We'll wrap it up with that. The recording will be sent to everyone who's registered, and the slides will be recording. So thanks everyone for your time today. And if you have any questions, please feel free to reach out to any members of the team or your usual KPMG contact.